Welcome to Tim's Strategy of the Week series. Today we're going to look at a strategy based on the accumulation and distribution of the big money traders. Stay right there. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of the Strategy of the Week. Hey, have you guys heard? I've got an app now. It's called the Comcash Alerts app. Stay around to the end of the video and I'll tell you a bit about it. I'll even explain what the name means. Today we're going to talk about taking advantage of the accumulation and distribution cycle of the big institutional traders, the guys I like to call the smart money traders. If you've been on this channel for more than a few minutes, you know that I place a lot of importance on the trade volume as a solid indicator of where the smart money traders are taking the price. Today we'll look at a Forex strategy that uses the Chaikin money flow indicator to give us that very information. I've said this before, in the Forex market we don't have a centralized exchange of total volume because we're trading over the counter. If we look at any trading platform like TradingView, they have a volume attached to their chart. But since we don't have a centralized exchange, that volume is coming from the feed that TradingView uses. Each retail Forex broker will have its own aggregate trading volume, or will use a somewhat universal price feed that combines the volume of several brokers together. I use that volume indicator as a representative sample of the volume for my breakout trades, but there are other tools we can use in Forex that will give us a good approximate of the volume. One of those is the Chaikin money flow indicator, which we'll be using in this strategy. And because I believe in working smarter, not harder, I will henceforth be calling it the CMF. The CMF indicator was developed by trading guru Marc Chaikin, who was coached by the most successful institutional traders in the world. The reason the CMF is a good indicator of the volume is that it measures institutional accumulation and distribution. Typically on a rally, the CMF should be above the zero line, and on sell-offs, the CMF should be below the zero line. The CMF will dramatically improve your timing and teach you how to trade defensively. Having a good defense when trading is important to keep the profits that you've earned. In this video, we're going to be looking at the buy side of the trade. Volume trading requires you to pay careful attention to the forces of supply and demand. When you use volume for trading, you need to look for instances of increased buying or selling orders. You must also pay attention to current price trends and potential price movements. In addition to that, you should also pay attention to the relative volume regardless of the raw number of transactions occurring in a trading period. Ask yourself, how is this particular market performing relative to what was expected? By learning how to use the CMF and other relevant indicators, you will easily be able to identify whether the buyers or the sellers are currently in control. Let's take a look at the trade steps. Step number 1. The CMF must shoot up in a straight line from below the zero line, a minimum of minus 0.15 distance, to above the zero line, a minimum of 0.15. When the volume goes from negative to positive hard and fast, that is likely a signal of strong institutional buying power. That's our base heavy lifting signal. When the big money traders step into the market, they leave a mark as their orders are so big they're impossible to hide. When the CMF goes straight from below zero to above zero and beyond, it shows accumulation by the smart money traders. As you know, I'm a big proponent of trading with the smart money guys, the big institutional traders. As the big guys go, so goes the market. Step number 2, wait for the CMF to slowly pull back below the zero line. The price needs to remain above the prior swing low. Once you've spotted the elephant in the room, so to speak, otherwise known as the institutional players, we start looking for the first sign of market weakness. We're going to let the CMF slowly drop below the zero line. The keyword here is slowly. We don't want to see the volume dropping fast because this will invalidate the accumulation we were initially looking for. Second, as the volume increases and drops below the zero line, we want to make sure the price remains above the prior swing low. This will confirm the smart money accumulation. Step number 3, buy once the CMF breaks back above the zero line. Wait for the candle to close before pulling the trigger. Now that we have observed real institutional money coming into the market, we wait for them to step back in and drive the market back up. When the CMF breaks back above zero, it signals an imminent rally as the smart money is trying to mark up the price again. We would need to wait for the candle close to confirm the CMF break above the zero line. Once everything aligns, we're free to open our long position. It is important, however, that the trigger candle closes in the upper 25% of the candle range. Otherwise, again, the accumulation that we are looking for is invalidated. Step number 4. Place your stop loss below the prior swing low. As always, using a stop loss is crucial if you want to have an idea of how much you could potentially lose on your trade. Never underestimate the power of placing a stop loss, as it can be life-saving. Simply place your stop loss under the previous pullback's low. I don't recommend using a mental stop. I recommend committing to your stop loss right at the moment you enter your trades. That way you won't have the tendency to fudge your stop and increase your loss. Trading with a tight stop loss can give you the opportunity to not just have a better reward to risk ratio, but also to trade a bigger lot size. And lastly, step number 5, take profit when the CMF drops below minus 0.15. Once the CMF drops back below minus 0.15, it indicates that the sellers are stepping in and it's time to take the money and run. We don't want to risk giving back some of the profits gained, so we liquidate our position at the first sign of the smart money stepping in on the other side of the market. We can always get back into the market later if the smart money buyers show up again. Remember, this was an example of a buy trade using the CMF. Use the same rules for a sell trade, but reverse your trade direction. Here's an actual sell trade example. The volume trading strategy will work well in any market because it's based on how the markets move up and down. Any market moves from an accumulation or distribution to a breakout and so forth. That's how the markets have been moving for over 100 years. You need to experiment with this strategy and see where it works best. My thought is that it will work best on the daily time frame since it's based on the actions of the institutional traders, and most of the time their trade sizes are way too large to successfully trade on the smaller time frames. The smart money guys always seek to mask their trading activities, but their footprints are still visible. We can read those marks using the proper tools. The CMF indicator will add additional value to your trading because it will give you a window into the volume activity the same way you have when you trade stocks. And that's it for this week's strategy. Guys, I am so excited. I've got an app. I've never had an app before. The tech geniuses at Trading Strategy Guides have launched an app for my trade picks. It's called the Calm Cash Alerts app. Where did that name come from? Interesting you should ask. If you've followed my trade picks for any time at all, you know I'm a lover of peace and calm and quiet. In the mornings I like to sit and drink coffee and watch the neighbors' kittens play in the yard. The breeze is softly blowing. It's a beautiful 70 degrees. This time of year, Texas is a wonderful place to be. Wait, I got sidetracked. My trade setups are based on daily charts, so you don't have to get in a hurry or get your knickers in a twist to make money with them. You only have to look at the setups in the afternoon just ahead of the market close, which happens at 4 p.m. for me in the U.S. Central Time Zone. And when you do, just see which ones you need to enter. The trade management is simple and calm, and, well, you get the idea. If you're looking for a fast and furious scalping for a few pips at a time, that's great. You do that. But you can still use the Calm Cash Alerts to make a bit of cash calmly in the longer term. Anyway, this app will allow you to see my trade picks from the YouTube channel, plus additional trade picks that I'm personally looking at. In fact, I've already added at least 5 new trade setups this week. Also, you can chat with me. Most days I get on the app several times, and I'll be happy to answer your questions or talk about the weather or whatever else happens to come up. So check it out. I put a link in the description box below. And be sure to come back next Wednesday as we will wrap up our discussion of trading strategies in our trading education series. And don't miss my trading picks of the week on Mondays and my strategy of the week on Friday right here at Trading Strategy Guides YouTube channel at 3 p.m. New York time. Be sure to subscribe and hit the bell so you'll be notified when these videos come out. Have a great weekend, and I'll see you with a couple of trade picks on Monday.